Hello everybody and welcome back to our webinar series. Pretty happy to be back, as a matter of fact. We've taken a little bit of a hiatus, but we're glad to be back in the saddle giving you some more information on how these markets really work and hopefully give you guys some insights as to how you can improve your financial well-being by maybe changing your perspective about preconceived notions you have about the marketplace. That said, today's topic will be about shorting. The industry is a wonderful way of making us believe that we can only make money when markets go up. Well, the focus of today will be about how to make money when markets drop. Now, we'll look at a lot of compelling facts here which might lead to a potential downside in these markets. Now, before we get started, I want to give us a little disclaimer here which basically says this is for educational purposes out there and not to be construed as direct advice and telling you to go and buy or sell anything, but is really more about the psychology and philosophy of market behavior. So, really, what we want to start with is the old phrase, you've all heard it, what goes up must come down. And there's another one we like to use as traders, says nothing goes up forever. Well, conveniently, we find ourselves in a situation right now where it feels like everything is going up forever. So we'll start with this kind of placeholder for us, which is that we have been taught to believe that we can only make money when markets go up. Buy and hold, buy, buy, buy. You always hear him saying that on TV, buy low, sell high. There's always this bias to you as an investor to be a purchaser and just hold on forever and just buy more and more and more, which is actually a good thing. Let's be honest, markets are designed architecturally to go up. They are fundamentally built to go up over time. Take, for example, your favorite sports team. I'm a fan of the San Francisco 49ers. I hope we don't lose viewers because I'm a 49ers fan. But what does my team and your sports team, whatever it is, do every season? They are constantly evaluating player performance. When one of those players underperforms consistently, have a bad game or two is fine, but if they consistently underperform, they get yanked from the team, and the team now goes and shops to find a better player to fill that position. Same thing happens with market indexes. If we look at the S&P 500, which most of you know, Dow Jones Industrial Average, NASDAQ 100, those indexes are constantly changing components to remove the bad ones and put in new ones. So technically, they're architecturally built to go up over time. Does that mean that they will always go up? No, absolutely not. So remember, we've been taught to go long. That is essentially buying low and selling something at a higher price. So buy it low, price rallies up, and we sell it higher. In this example, if you bought it at 10, you sold it at 20 bucks, your profit is going to be $10 minus commissions. So that's pretty easy. Well, let's take a look at the opposite side of this. I'm going to throw a curveball at you. And let's say you saw this Mini Cooper and you've just been dying to get a nice old vintage Mini Cooper and you find it online. It even has the license plate, great deal. And the guy gives you a price on it that is unbelievable. And let's say this car is worth about 12 grand and he says, you know what, I'll sell it to you for 6. And you're rushing to buy that car because it's 6 grand? I can flip this thing tomorrow and make money on it. And he says, well, hey, why don't you jump in real quick? I'm going to show you something. It's a little bit different with this car. Here's the gear shift. I said, okay, great. It's a 6-speed. I've always wanted a 6-speed. He goes, yeah, it's missing something. Oh, wow, yeah. It doesn't have reverse. Look, none of you would ever buy a car that doesn't have reverse. How do you parallel park, right? You wouldn't be able to drive your car the same way, especially if you live in the city. So reverse is key, and that is where the market reality is set in for going short. Markets have periods of time, whether it's an intraday, meaning a 5-minute chart, 3-minute period, a week, an hour, a year. There's periods where price will be declining, and we can make money just as easily when stocks are going down by what's called shorting them. And the mechanics are just the exact opposite of what we do when we go long. Remember, when we go long, we buy low and we sell high. With shorting, we sell high and then we look to buy low once price drops. In this example here, had we shorted at $20 and bought back at 10, we would pocket $10 worth of profit minus commissions. Now, there's a lot of other factors we're going to cover today, but that is the gist of it. And right now, you're probably thinking, hold on a second, Merlin, you just told me I can sell something. I don't own it? I got a bridge I want to sell you, right? Well, if someone's going to loan you the bridge to sell, then yeah, you could short that bridge. So we'll talk about the mechanics here shortly on how to short. But I want to set the stage bigger and really give you guys an understanding of how this applies to us on a much more macro level and the importance it's going to have on our accounts. Markets move because of two fundamental factors. Of course, if you're an Online Trading Academy graduate, you know that that is supply and demand. Now, there's another factor, a couple of factors out there that is really the the fuel for that, and that is fear and that is greed. So take a peek at this chart here. Obviously, we had a significant move up and a massive move down, but let's look at the numbers to back this up. You can see this huge move here. That move, which took 4 months to move from, looks to be right around 12 bucks to almost 35, that was a $22 gain in 5 months. And all of a sudden, in a period, a very short period of just 11 days, it gave it all back. That's because fear is a much stronger motivator than greed. And we tend to see these market moves much faster to the downside than we do to the upside, which makes shorting very appealing. Now, I want to look back historically, and this goes all the way back to 1993 through 2018. And I have this argument with people constantly. And they say, markets only go up. They only go up. All you have to do is buy and just hold on forever, and you're going to make a bunch of money. That might be true. But it depends on when you started buying. It depends on those rates of return. It depends on market moves. So I'm going to walk you through some pretty significant market moves to the upside and to the downside. And every time I show you a downside, I want you to think about what happened to your 401k, what happened to your long-term accounts, what even happened maybe to your active trading portfolio. Because since we're all biased to go long, you probably took a big hit. So you can see here we had a huge rally up from 1995 to 2000, early 2000. That was a 250% market move. Phenomenal. And mind you, back here in the early part of this, right about in here, that was when Alan Greenspan came out and said, irrational exuberance. I wonder what he would be saying today. So right after that, from 2000 to 2003, we had a 50% decline in the markets. So yes, markets are still going up, but there's a huge decline. That's a massive loss of capital. And if we're still in a buy and hold mentality, you lost 50%. Now, granted, it did move another, what we have, about 105% from 2002 to 2007. And of course, from 2007 to 2009, we had our monster crash of 57% again. And right now, we are in the midst of a massive bull rally, which to me looks like it's a little bit long in the tooth. I think we would all agree by looking at these charts right here that this is a little bit extended. Not to say it can't go any higher, but it's just feels like it's gonna have a pullback at some point. And you guys can all comment if you like. We're watching our YouTube channel out there. If you think that this is gonna have a correction, let me know. I think at some point we are going to have one. And if history is any indicator, gosh, 50% would be a massive sell-off for this market. I don't think it'll be 50%, but it could be. Now, let's take this one step further. This chart obviously is showing you big gains and big declines, but that's not the most important part. The most important part is this. If you were a buy and hold investor who believed that I just need to buy because markets will always go up, and you bought in 2000 and you didn't sell, well, from 2000 to 2007, the markets were sideways for 7 years. That means that you had, let's say, $10,000 gains in 2000. It took you 7 years to get that money back. 7 years to come right back to where you were. And notice that right as it got right back to that point, the market sold off yet again and stayed underwater for another 6 years. This is essentially from 2000 to 2013, the markets did not make a new high. That is 13 years of capital sitting idle, wasted time and wasted money. So I can't disagree with people who say markets go up over time. What I'm saying is that through the course of time, there are fluctuations in market behavior that we shouldn't just sit there and let our capital be eroded because of a pull down in the market of, say, 20, 30, 40, 50%. Now, a lot of people had that happen in 2000. I was one of them that was kind of caught off guard with that because it was the first bear market I was ever a part of. The one in 2007 and 2008, one of the greatest trading times of my life. I was actually kicked off CNBC for my bearish comments, but that's another story. So the point we want to make here is markets do go up over time. There are significant sell-offs during that up move, and that is wasted time for our capital if we don't act on it. So let's take a look a little bit deeper. That was the overall market. And what I want to emphasize here is, depending on your level of understanding of financial markets, we can dive deeper within the market to find out what's going on. So what we're going to look at now is 11 major market sectors. Here we have a line chart that shows you percentage returns of 11 major market sectors which make up the S&P 500. Now, it's also has the S&P 500 on there, and you can see since 2017, most of the market has been doing very well. Up here at the top, you see technology is up 36%. That's that blue line. Clearly the big leader since 2017. But even though we've had some of the robust bullish markets we've ever seen, there still are markets to the downside. Notice down here at the bottom, I've got XLE. It's down 19% since 2017. Now this image is a few months old, but it's still the worst performer out there. So what we could do if we were looking for shorting opportunities is we could say, all right, XLE is the weakest. Let me break apart XLE and see what I can find in there that might be even weaker. So here we are looking at XLE, which is an energy exchange traded fund. For those who don't know what an ETF is, it's a basket of securities that represent a specific target. In this case, it's the energy sector. So here I've just looked from 2018 through till today. And you can see that even though it's the weakest performer out there, there's some that are doing very well. For example, top one here, ConocoPhillips, up 29%, looking fantastic. But down here at the bottom, we have Schlumberger and ExxonMobil down about 5.5%. We also have the weakest of the group, Halliburton, down over 15%. So if I'm trying to find a market to short, again, it's about scanning, analyzing strength and weakness within those specific sectors or that specific market. Now, let's talk about how do you go short? Because I mentioned early on, you sell something first, and you're like, well, how do you sell something that you don't own? Well, essentially, you're borrowing that, and I'll walk you through step-by-step mechanics here. So here's the overall process. Step number one is in order to short, you have to have a margin account. So first, wherever you keep your brokerage account, set up a margin account. Next, when you find an opportunity, something that you would like to short, so let's say you wanted to short Tesla, since everybody seems to be hating on Tesla right now, borrow shares from your broker, you would sell those shares to a buyer, and at a certain point when it went to a price that you felt was a good time to get out, you would buy back the shares and return to the broker and hopefully make a profit. That is the very, very basics of it. So I'm going to walk you through a little bit deeper dive into this as far as how it works, where you get those shares from. So we looked at step one. The mechanics was, right, open a margin account. So let's say we open up a brokerage account. Here we've got broker A. It could be any broker, guys. They're all over the place. So you can short at E-Trade, you can short at TradeStation, you can short at Ameritrade, you can short at JP Morgan. It's just have a broker and a margin account. Now, where am I getting those shares? I'm essentially getting them from that broker. And how does the broker get them? Well, first, they're going to try to get them from their customers. Now, this is a part that's going to make everybody go, what? Are you serious? If you have a brokerage account right now, and let's say, for example, you inherited 1,000 shares of Microsoft, and you've been sitting on those shares for 10, 15 years. You don't have any plan of getting rid of them. If they're sitting at a broker, most likely your broker made you sign 20 or 30 pages of documentation, which I will take the wager that all of you did not read every page that you clicked, okay, I agree, I accept. One of those things that you clicked on basically said you are allowing them to take your shares out of your account and loan them out to somebody else who would like to short those. Bet you didn't know that, huh? To call your broker, find out. It's going to happen for everybody that's watching this program right now. I haven't seen a broker that doesn't allow that. You can actually specify to not allow them to do that, but let's be honest, how do you know that they haven't loaned your shares out? So let's say that my friend Dave, he's got an account at broker A. I want to go out there and I want to short Microsoft. Great. Well, Dave in his long-term account, he has 1,000 shares of Microsoft. I want to short it. I think it's going down. Dave just wants to hold it. I am actually potentially borrowing shares out of Dave's account to sell to somebody else. Seems kind of weird, but that's the way shorting works. You're borrowing it from someone. So your broker will get it from their customer base. That said, the bigger the brokerage firm, the more customers they have, the more likely you're going to be able to go short specific securities. So they're going to get it first from their customer base. Number two, they're going to go out to a third-party broker, meaning they'll have relationships with other brokerage firms. So broker A might go to broker B or C or D and say, hey, we've got a client who would like to short these shares. Can you loan them to us? And it'll pass through. So that's step number two, would be the third-party broker. The third option here is the own broker's inventory. Remember, brokerage firms are in the business of making money. They are actively buying and selling as well for their own portfolios, and they may actually loan you out of their inventory if they felt it was appropriate. So they're getting it from one of three ways: their customers, a third-party broker, or brokerage inventory. So that's where they would get the shares for you. Now the next step is, how do you open it? Well, it's actually really easy. On your platforms, whichever platform you're using, there's in the stock, if you're trading stocks, there's a button that says sell short. That's easy, right? So you've got buy and you have sell short. So if you have no positions, those are the two buttons you'll see on your platform. Buy means you want it to go up. Sell short means you want it to go down. Doesn't get much easier than that. So if the sell short button is there, you hit it on the security that you like and you want to go short, here's the mechanics behind the scenes of what's going on. Essentially, in an instant, you are borrowing those shares from your broker. You are selling them to somebody in the open market. Who cares? You don't know who it is. You're just selling to somebody. There's a buyer out there willing to buy those shares. That buyer is paying to buy those shares, and that money would pass through you and go back to the broker as collateral for the position that you've borrowed. So that's the mechanics of how you go short. When you hit that button, all four of those transactions would be taking place almost instantaneously, depending on your order type, whether it was a limit or a market order. So that's how you open it. Now, what does it look like? Well, it would look like this. Here's the individual. They've borrowed their shares from broker A, and they said, I'm going to sell 1,000 shares short at $20. All right, so you sold 1,000 shares short. Now, this depends on you what time frame it is. This could be 1 minute, could be 1 hour, could be 1 year, could be a decade if they let you hold it that long. Now let's say it drops all the way down to $17, and you go, you know what? I want to get out at 17. I feel like this is where it's going to stop. Maybe it came into a great demand level. I'm done. So you would have to what's called buy to cover. So you buy to cover your short position at 17. And that would give you a profit of $3,000 less commissions. So in this example, pretty clear and easy. Hopefully you guys can all understand that. If it's not clear, feel free to let me know in the chat, and I'll dive deeper and explain it. Now I mentioned on the buy portion of this that you have what's called buy to cover. Remember, you need to close the trade. This is one of the tougher pieces because a lot of people, when you go to close a trade, they feel like you have to hit that sell button. Well, no, in this you're actually hitting buy. It's buy to cover. So what happens when you buy to cover? Well, it's the same basic process. There's a seller out there somewhere. You need to go and buy from that seller, right? So you already sold short. Now you need to buy the shares in the open market. You find the seller, you buy the shares, and then you return those shares to the broker, and any difference, whether it's a gain or a loss, is added or deducted from your account. That is the essence of shorting and where you get those shares from. Now, a lot of people, before I go to this next image here, a lot of people feel that shorting is anti-patriotic. I have to dispel this one right now because I think we would all agree that over the course of time, we have all heard of some companies who were, we'll just say, fraudulent, doing things they shouldn't have been doing. Some come to mind like, oh, I don't know, Enron, maybe WorldCom. You have companies that have taken on way too much debt to get to the price level that they're at, and they deserve to sell off because of the risk associated. So it's not that you're anti-patriotic. It's that you're looking at the valuations from the fundamental perspective and say it's overvalued. Or you're looking at it from a technical perspective and you're saying, you know what? This is clearly at a supply level. There's a huge amount of sellers here. It's going to go down. Don't think about it as anti-patriotic. Remember, you're getting involved in trading to generate income and grow your wealth. So let's put that bias aside and say, if something looks like it's going to go down and you have a high probability that it's going to using your odds enhancers, then go short. Don't be pessimistic about it. It's just the same as going long. Markets go up, markets go down. All right, let's take a step back from the equity side of things. Right now we've been talking about how you go short in the stock market. Well, let's look at other ways to go short. You don't have to just trade stocks. There are a ton of other asset classes out there, and some of them give you great opportunities. So the asset class we've been looking at was stocks, and your action to make money when prices drop is going short. And of course, I'm sure many of you looking at this chart of General Electric right now would love to have gone short General Electric as it seems to continually slide. But we could also look at the futures market. Now in futures market, you don't sell short. You simply sell. You've got two buttons on futures platforms. If you think it's going up, you hit buy, and when you want to close it, you hit sell. If you think it's going to go down, you hit sell, and when you want to close it, you hit buy. Very simple. Here you can see a chart of soybeans over the last few months. I mean, it's down almost 25% in the last few months. That is huge because of the leverage of the futures markets. We could also go out to the Forex markets. You see these Euro-US dollar right here. US dollars down, Euro-US dollar down about 800 pips in the last couple of months. That is a massive amount of opportunity. And Forex, all you would have to do is just hit sell Euro USD. If you want it to go long, you hit buy. You want to make money when it goes down, you hit sell. Perfect. Very simple. It's actually much easier in the futures and Forex markets. Stock markets have a bunch of rules, which I'll cover here shortly. Our fourth option is literally that, options. We could be buying puts or selling calls. That's a bit more complex and outside the scope of this discussion. If you want more information on that, you can always visit Online Trading Academy to get more information on options. You could buy puts and calls on stocks, futures, Forex, and a wide variety of asset classes out there. So it's really one of the more flexible ones that you have in the marketplace. Okay, so one of our YouTube listeners says, those same companies sell short as well. Yeah, you do have these major financial firms selling short. Absolutely. Remember, they're in the business to make money. And we always talk about this in a lot of the materials we looked at otacademy.com, which is the industry is designed to create reaction from individual investors. So when you hear of an institution saying, hey, we think this is a great buy, always think to yourself, they're probably selling. Look at the price action and see if it's coming into a supply level. We recently had some upgrades on companies that missed earnings, and they're trying to jack the price up. Why? Because I think that those institutions are looking to sell and vice versa. So always watch what the institutions say with a grain of salt. All right, so let's talk about risk. Obviously, our job, my main job as a trader is managing risk. Making money is a secondary thing. It's actually a byproduct of proper risk management is making money. So when we go long, when you buy something and you sell it at a higher price, your trade can only go to zero. So let's say I bought, I bought Apple at 180 bucks a share. Well, if it's just a cash transaction, I'm not using margin, Apple goes to zero, I lose 180 bucks per share. So it can only go to zero. You have limited risk in the situation. Right here we have an example of a security that's just been getting slaughtered lately. It's at 10 cents right now. Well, if you bought this security long, how much are you risking? 10 cents, right? So you can start to define your risk limits by looking at going long. Long, you have limited risk because it can only go to zero. On the flip side of this, going short has unlimited risk. I put it on the screen here. It says sky is the limit because that is literally the limit. There is no limit here. It's sky high. It could go straight up forever. Now, that's probably not going to happen, but we've seen some colossal moves in the markets where you may have lost a lot of money. So, for example, let's say you decided to short this security, and you can see where this red line just came up on your screen. If you shorted this at $20 back in April, it didn't look like a bad idea because it had been trending down significantly. It went from 30 all the way down to 20. Man, that's a 30% decline in price. The trend is down. Probably want to go short. Well, all of a sudden it started to rally, and if you just use straight cash, no margin, by the time this thing got up to 40, if you shorted at 20 and you covered at 40, you lost 100% of your investment. All of it's gone. And if it happened to gap up or move more than that, you could potentially lose more than your investment. Let me give you an example of that one. So here is a pharmaceutical company that I'm assuming they got FDA approval or announced some new drug. Well, look at the price here. If you shorted this security at $7, and there's a lot of people out there that short these biotech stocks because, they're losing a lot of money. Look, almost every biotech and pharmaceutical company on their balance sheets is losing money until they hit it big. And when they hit it big, they skyrocket. So if you shorted this one at 7, the next morning, it gapped up at $14.50. You literally lost 100% of your investment, plus you would actually owe more money. So, for example, let's say it was straight cash, right? You bought a 1,000 shares, you shorted 1,000 shares at $7. That's $7,000, and that's all the money you had in your account. The next day, gapped up to 14. Well, you would now need to, or 14.50. You'd now need to, you'd lose all your 7, plus you'd have to put in another $500 to make up for that extra 50 cents on this one. So you could lose a lot more. If it gapped up to, let's say, $20 on this, you would lose your $7 investment, plus you would need to put in another $13,000 into this account. So sky is the limit. Very dangerous here. Always keep that in mind. Shorts can be very, very risky. So let's look at what you can short. What are some of the things that you can short? Because there's a lot of misconceptions about there in the marketplace about shorting. Pretty much, with regards to stocks, you can pretty much short anything that your broker will let you. Now, there are a couple of caveats here. Most brokers will have what's called a master trade list, which is master short list, excuse me, which will identify the securities that you can short. When you can have difficulty, you may have difficulty shorting stocks that are very thinly traded. So for example, if something trades, let's say 500 shares or maybe 10,000 or maybe even 100,000 shares a day, that's thinly traded. The odds are your broker is not going to have enough shares to lend to you. So they may just say, nope, you can't short that one. Another one is penny stocks. Now, this is an interesting one because I have read some stories. There's an individual out there who always brags about how much money he makes trading penny stocks, and I think he just got really, really lucky because let's be honest, why are you shorting something that's 5 cents? Where's it going to go? The odds are probably much higher that it's going to go to 6 cents or 10 cents or 50 cents than go down to 4 and you made yourself 20% rate of return. So penny stocks, there's a reason you shouldn't be shorting those ones, and I'm glad that a lot of brokerage firms won't let you short them. Now, the final one, which is there's a lot of misinformation about this. You may have heard in the industry that you cannot short an IPO for 30 days. That is false. That is not true. You can short an IPO immediately. Here's the catch. Let's say, for example, it was Merlin.com, right? So I went public. I'm now listed on the stock exchange, and my underwriter was Goldman Sachs. If you're a Goldman Sachs client, you wouldn't be able to short Merlin.com because whoever the underwriter is cannot lend out shares for 30 days. But if you're a JP Morgan or an Ameritrade or something else, you can. Most of the time, though, they won't let you. It's just a matter of there's no price history, there's not a lot of liquidity out there, they may not have shares in their inventory. So generally, you don't see shorting going on with IPOs, but if your broker lets you, you could, and you're not violating anything with regards to legal rules in the marketplace. So that's the basics of what you can short. Now, when it comes to things like the futures markets, the options market, Forex, with Forex and futures, you can short everything, right? If you can buy it, you can sell it as well, and that would make money when markets drop. With the options, it's a bit trickier, right? Because the options, it depends on if there's a market for the option on that specific instrument. So let's say Merlin.com, it's very thinly traded. Not a lot of people are active in it. It's unfortunate because I'm such a great company. And there might not be options traded on that security. So you want to make sure you go look at the options markets. Of course, there's a lot of details that go into each of these asset classes, like the stocks, the futures, Forex, and the options markets. And I would encourage you that if you are interested in learning more, you can go to Online Trading Academy to get more information about that. If you're in the YouTube channel right now, a link popped up there so you can get more information about how these markets work. And before you run out there and try to short, really be careful, right? There are a lot of risks out there. The whole goal of today was to really make you understand that there is another side to the market. Just like you buy a car that has a reverse in case you need to back up, you should always have that approach in the equity markets. Now, we are up over 330% since 2009. Could we be up 500? Yep. Could we be up 1,000? Yep. Could we drop 50%? Yep. The longer we go at this huge bullish market phase, at some point you have to ask yourself, where's the capital coming from to continually push it up? Because we have far exceeded the highs from 2000, far exceeded the highs from 2007. We're like double those at this point. So at some point, we're going to see these markets sell off. And my hope is that, number one, you guys are apt and skilled at market timing. Why? So when those market changes come, you can back away and say, you know what, I'm going to cash. I don't want to be involved anymore. Let's just be safe and go to cash. That's the safest thing that you can do. Number two, maybe you are a little more active. And you say, you know what? These markets look like they're now downtrending. We've got a series of lower highs and lower lows. I'm getting all the signals that supply levels are much stronger than demand levels. Supply levels are in control, and it keeps pushing price down. You know what? I now know the basics of shorting. I'm going to start to short this market and make money when markets drop. If a market drops 50% and you're holding long, you lose 50%. But if you manage just one little bit to pull your money out, go short for a little bit, and let's say you capture 10% of that move, now you're beating almost everybody else in the marketplace because most people, the retail investor, is buying and holding. We don't want to be that retail investor when that market crashes. And you notice I didn't say if, it's a matter of when. Markets always have rallies, markets always have crashes. So be careful out there. Hopefully today's presentation gave you a greater understanding of how shorting works, the opportunity it poses to you, and the mechanics behind it. If you'd like to learn more, there's a bunch of free videos at otacademy.com to help you learn all you need to know about trading and investing from a broad perspective in these financial markets. Take care, guys. We'll see you soon.